And an interesting part of this, because it brings me to like the way I always look at banking profitability on a super high level is at the end of the day, any profitability, whether it's bank or whatever, is always revenue minus cost. Well, let's leave the revenue side of the equation a little bit, but look at the cost side of the equation. And if you look at banking, for me, it's always like threefold. One is the default risk. If you have a loan and you don't get it repaid, that's definitely a cost. Then
Yep.
second is the cost of money. I mean, you have to get
Yep.
money in to be able to lend money out. So that's the cost of money. And but third is then the operational cost. And when we talk about this whole switch from branch to digital, that is a big difference in operational cost going on. So that's a very logical discussion to tend towards. But how would you look at the other two elements like default cost and yeah, money cost? Because if I talk especially to like the sales guys, they say, oh, the operational costs don't matter, which I think, and we'll get back to that later, they matter a lot. But just for us to understand a little bit, I'd like to hear your view on the other two.
Yeah, and I will give the benefit of the doubt to the people who say the operational costs don't matter. More, it's the operational cost. Most banks, when you talk about their operational costs, they're going to say, hey, we have engineers in who study these things to make things the most efficient. It's more tangible and it's more controllable. They set their budgets, they set their staffing levels, they can make the adjustments, they can control that, so it becomes a little bit more tangible. So I don't think they say it doesn't matter. We've been dealing with this for decades on decades of understanding and managing these things. When you get to the cost of capital and you also get into your risk, that is where the concern comes, because there are market factors that an executive at a bank can't control
Exactly.
on their profitability. Right now, from a cost of capital, and part of it's set by the Fed, where you have your interest rates. And for the most part, there's people who study that and they can understand where things are going in general. But the market does set the yield curves, and has impact of that beyond just your prime rates in the market. And the market becomes something that becomes a little bit more intangible, a little bit more vague, because there are plenty of factors that play into what your curves are for your cost of money. And then when it comes to your risk of your loans, once again, you're dependent upon the risk profile of whomever your customer is that you made that loan to. And so we look at this post-pandemic situation, and the retail space that is open, or the commercial space for leases where people have still worked from home, and you have all the vacancies in all of these large cities with all these buildings. There's a risk there now to the banks about something that was beyond their control, that now they get more concerned about, because that the cascading impacts of defaults on loans for commercial properties is a legitimate risk in the future. And so understanding what their exposure is, understanding what would happen and what they can bear, and their ability to proactively get in front of that risk, as well as understanding how much they can handle, and then, or just what their exposure is very important when it comes to profitability measurement and management, and understanding that true impact. And so I think that's probably what they mean more when they say they don't care about, or they got the operational side under control. I think they do care very much, but it is, when you look at your largest risk or your largest uncertainty, it's in those two areas where they have less control.
I totally
And so
agree.
a key to a good profitability model isn't, we can't solve all those issues. A profitability model cannot tell them what's going to happen to their loan portfolio and where they're going to have larger defaults or not. What we can do is measure it, and then apply some predictive thought into it about if trends hold or if things change, to allow them to be a lot more proactive in their management decisions.